Okay, thanks for joining us today for this webinar presented by ESS Small Business in conjunction with ESS BIZTOOLS. I'm Peter Towers. I'm the Managing Director of ESS BIZTOOLS and ESS Small Business. Today we're going to talk about something very interesting, an opportunity to finance your business. If during the webinar you have any questions, can you please type your questions into your computer and I will answer the webinar questions as we proceed through the webinar. An opportunity to finance your business without security, without personal guarantees, without monthly payments having to be made back to the bank or the lender. Undoubtedly, that sounds great to anyone running a small business or a medium-sized enterprise. Would you like to be in this position? Seriously? Someone said to me the other day, can we finance our business without security, personal guarantees, and monthly payments? Well, you can if you take advantage of the biggest change that occurred in business finance for small businesses and medium-sized enterprises in the last 35 years. And that was crowdsource funding equity raising. Has commenced in Australia. At long last, $23.1 million has been raised already by 27 companies. So let's look at the crowdsource funding equity raising scorecard. This is a document we're producing to alert people as to what is happening in this industry. So there's the summary page. This process is organised by intermediaries, which are finance companies that have been appointed by the Australian Security Investment Commission to be both the gatekeeper and the promoter to assist companies to raise capital. So a total of $23.1 million has been raised by 27 companies in total. On our system, we have a detailed scorecard which enables people, primarily accountants who are subscribers to our ESS BIZTOOLS product, to be able to check on what is happening in the individual market. So let's go through some of these companies here. Average investment, $949, 5708, 1651. The highest amount that a retail investor can invest is $10,000. And a retail investor is someone who is not a sophisticated investor. A sophisticated investor generally is someone who has a net worth of at least $2.5 million or the last 2 years had a gross income for taxation purposes that exceeded $250,000 and have a certificate signed by their accountant saying that they are sophisticated investors. In the main, crowdsource funding is targeted at retail investors. And we look here now, we can see the number of investors in these companies, 588, 115, 1568, 177, 116, 290, 122. You can have any number of investors in a crowdsource funding company. We then have virtual in Melbourne. So this market's alive. Enable funding in Adelaide. On market in Sydney, and so on. So crowdsource funding has occurred. Did you know anything about it? Has anyone been talking to you about it? Do you think you might like to be able to raise some capital? Why will crowdsource funding equity raising receive a vote of thanks by small and medium-sized enterprises, the sort of people that are watching this webinar? We think you will find crowdsource funding very exciting because it's already been proven in overseas countries. Australia's playing catch-up. It's like we've only come on to play a football game for the last 10 minutes. because the United Kingdom, the United States of America, Canada, New Zealand, and parts of Europe have had crowdsourced funding equity raising for 6 to 7 years. Yes, 6 to 7 years. And in Australia, we did nothing during that period. Now's the time to catch up. There's been billions of dollars raised for small and medium-sized businesses in these overseas countries during that 6 or 7 year period. So small proprietary companies, a PTY Ltd company, can now raise capital direct from the public. You don't need to be an unlisted public company, which is what the legislation originally said. But that was changed from the 19th of October 2018 to allow small proprietary companies to be able to raise capital. If you're currently trading as a partnership or a sole trader, but you've got great prospects in the future, you've got a fire burning in your belly as to what you believe your business can achieve, you could roll your current business into a company and take advantage of this legislation. So you don't have to have a history of being in business for a number of years before you go down this path. Eligible companies may be able to raise equity finance. Obviously, may be able is a key phraseology. You've got to go through the process. But you might be able to raise without security, without personal guarantees, without monthly repayments. Very important for a lot of small and medium-sized enterprises. Crowdsourced funding is definitely a win for the small and medium enterprises who are eligible to take advantage. And I'm going to go through the eligibility guidelines shortly. Now, the key eligibility is that your group turnover must be under $25 million per annum. So besides $25 million, the key word there is group. So if you're part of a group, the whole group has got to be considered, not an individual company. And the group gross assets must be valued at less than $25 million. So that's your plant, equipment, debtors, bank accounts, land and buildings if they're in the name of the company or a company within the group. When it's all added up, must be under 25 million. And no member of the group can be listed on a stock exchange anywhere in the world, not just in Australia, anywhere in the world. And you cannot be raising the money just to put it into a bank account and create what the legislation calls a credit facility. You've got to put it to work. Okay, that's pretty easy. There's no regulations relating to the age of the company. Some people are getting confused and are confusing crowdsourced funding equity raising process with early stage innovation companies. Early stage innovation companies legislation was introduced to Parliament at the same time as the crowdsourced funding. They were running mates. Unfortunately, in the parliamentary process, they got separated, and we've had early stage innovation company legislation in place for about 18 months before crowdsourced funding got started. Early stage innovation companies has a 3-year age limit. No age limit applies to crowdsourced funding. None at all. And there is no industry specification. You can apply for the status of a crowdsourced funding company irrespective of the industry, as long as the industry is appropriately approved by any other licensing authority. Now, what are investors going to be looking for? Remember, the investors are mum and dad investors. They could be your friends, your neighbours, your golf club mates, people that sit near you at the footy. They'll be looking for someone that's got an exciting vision. So you're going to have to be able to tell the story. They'll be looking for a strong management team that wants to work for the benefit of all shareholders. So a company is going to have a key group of people, or has made provision in their offer document that they're going to employ some very strong people within the management positions of the company. It might seem strange talking about an exit strategy when we're only talking about getting started, but shareholders want to know that you have thought about an exit. They're probably not interested in having their shareholding locked up in your company for the next 30 years, unless it's really going to grow. But in the main, they'll be looking for the management and the directors to be talking about the possibility of doing an IPO, an initial public offer to list as a public company in a few years' time, and that they're using the crowdsourced funding process as an apprenticeship on ultimately becoming a public company. Or they may say that they're going to get themselves into a position where they're going to be very attractive to a larger company to buy them out in the next 5 or 6 years. So that's what we mean by exit strategy. So that the shareholders know that there's going to be the opportunity for them to be able to liquidate their investment from their point of view, hopefully at a profit at some time in the future, and that the management team and directors are thinking about this. They also want to have confidence that the board of directors and management team, you, in whatever company you're representing, listening to this webinar, that you will spend the money raised wisely. No one likes to see a company that's just gone out and raised $1 million to expand their business suddenly going and buying a Mercedes-Benz motor vehicle for each of the 3 directors. That's not, in my opinion, spending the money wisely. If cars have to be provided, they should be basic, everyday business cars, not status symbols. We've developed a document which will help understand the combination of what's involved in this whole process. And we've called that the crowdsourced funding equity raising eligibility matrix. So you might check yourself against this type of document. And this is one of the free documents that we have available to you that I'm going to talk to you about at the end of this webinar. So they need a group turnover under $25 million, group asset value. We've talked about those. So you look at that and say, yeah, we're under all those. Just a note, obviously saying that the age of the company and the businesses doesn't matter. And then we're giving you some examples of some of the key characteristics that might apply to your business. Because you're going to have to be able to exhibit to investors that there's some real reason why they should invest in your business. So you might be a company that's wanting to grow, wanting to scale up. You currently might have a turnover of $2 million in whatever you're doing. And you have a vision that in 2 years' time, you'll have a turnover of 4 million or 5 million. Now, unfortunately, there are always growing pains in every company. And if you want to do that, you'll probably find you need extra investment in some of these items, inventory, debtors, plant and equipment. You may have to spend money on research and development. Where are you going to get that money from? Now, you may have a source of being able to find that money because you've got assets that you can secure and borrow on and then issue the personal guarantees. But if you want to avoid all that, crowdsourced funding could be a way to do it. Or you might be a fast-growing, ambitious business. Or you're wanting to buy other businesses. Or your CEO may have a big, audacious idea. It might be you. You've got a big, audacious idea. That's great. But you then need to document what that idea is so it can be presented to potential investors to get them to buy in to your vision, your idea. Or you might have borrowings at present that are secured on other people's property. Could be some of the director's personal property, might even be the director's mother-in-law's home unit. And that person's mother-in-law has decided she wants to retire or move. She'd like to get her title deed back so she can do something else with that asset. So what's the company do? It mightn't be convenient at this stage. It's going to be very difficult to borrow from banks for the next 3 to 4 years. So crowdsourced funding could be an opportunity. And there's no interest, and there's no monthly repayments, and there's definitely no guarantees. Your company may have borrowed money from parents or grandparents, commonly referred to as the bank of mum and dad. And mum and dad or grandparents may be wanting to look at some retirement. And they need some money back. This could be a way of funding that. Or it could be a succession issue. Or it could be a company that perhaps would have fitted the criteria to be an early stage innovation company because your company's developed a new product, process, or service. But you're either over 3 years of age, or your income's over $200,000, or your expenditure's over $1 million, and therefore you're not eligible for the early stage innovation company status. That's bad luck because investors in an early stage innovation company do get some taxation benefits. They get a tax offset on their investment, and they also can escape capital gains tax on that investment. But you are not going to be eligible for that if you're too old or too big. So crowdsourced funding could be the area for you to look at. Now, how much capital can you raise? We can raise $5 million every 12 months. That's a lot of money. But you've got to get market support. You've got to be able to tell the story and make the presentations and make everything look interesting. There's a new word that's emerged in the Australian corporate world over the last 18 months, and that's called intermediaries. We've probably all got an idea what in the traditional sense an intermediary is. It's normally someone acts as a bit of a go-between and does some negotiations. Well, that's the terminology that the government chose to describe the people who are the key group of functionaries that bring this whole process of crowdsourced funding, equity raising to the surface. They've been appointed by the Australian Security and Investment Commission, and currently 13 intermediaries have been appointed. They all have an Australian Financial Services licence. But they act in a dual role. They are the gatekeepers on behalf of ASIC, and that's the terminology that the then Treasurer and now Prime Minister, Mr. Morrison, used when he introduced this legislation to Parliament. So the intermediaries have to check that the law's been complied with. And that's very important because this borrowing's all been done under the Corporations Act. Sorry, not borrowing. This investing's all been controlled under the Corporations Act. But the intermediaries are also promoters, where they wear a promoter's hat as well, because they have thousands of people who have registered with them to make investments into good companies. So they're wearing a dual hat. Every company that aspires to utilize crowdsourced funding must appoint an intermediary. But you can talk to a few of them before making that decision. The legislation doesn't specify the fee to be paid to the intermediary, so the fee is to be determined by negotiations. And the fees could range from 4% to 8% on what I've seen recently. And it does depend on the size of the deal. That's based on the amount of capital raised. And the fees could be paid in cash or in shares in the company. But the key thing is that the fee arrangement must be disclosed in the document that is submitted to potential investors, and that is called the crowdsourced funding offer document. It's a de facto prospectus, and it also must be disclosed on the intermediary's website. I've already told you that the intermediaries have thousands of people on their databases who they will go to talk about your company if you've elected to go on this journey. The intermediary's prime responsibility is to make sure that the company has complied with the Corporations Act, and that requires a lot of disclosure. Another very important process is that all share subscriptions must be processed by the intermediary's website. So a company director can't accept $200 from his favourite aunt and say, yes, okay, I'll put that into the company books and we'll issue some shares to you. Every investment must be made personally on the intermediary's website, because the government requires every investor in a crowdsourced funding company to acknowledge that they understand the investment warning. Because investing in any business is risky, and the government really wants investors in crowdsourced funding companies to clearly understand that. So that's the reason that all share applications must be processed via the intermediary's website. And as an investor, the investor has to acknowledge that they have read and understand the investment warning. And the maximum investment that a retail investor can make is $10,000 per company in a 12-month period. That's the maximum. I showed you some of the averages back there before. $1,000, $2,000, $4,000 average. Another very important protection in this legislation is that an investor has a 5 business day cooling off period. So they've signed on today and agreed to pay $2,000, and they've paid that money to the intermediary. They then have 5 business days to change their mind. Unfortunately, this could lead to some competitors of businesses making a shareholding, obtaining the offer document and asking questions and getting other information, and then withdrawing their application before the 5th business day has finished. Unfortunately, that's one of the risks. And as business people, you need to understand that could happen. It's one of the costs of implementing this. The offer can only be on the intermediary's website for 90 days. That is the absolute maximum period. It can be a shorter period if the directors indicate that they want it for a shorter period. I would never recommend that. I think you always should list for the maximum, 90 days. The key document is the crowdsourced funding offer document. It's a prospectus. Who's responsible for it? The directors and senior management of the team. The intermediary will want to work with you on this, but I think most of you will need to engage your firm's accounting firm if they're prepared to assist in the preparation of the offer document. If your accountants are only wanting to do taxation work, if you contact us, we can offer you a service to assist you on this process. So don't give up because your accountants are only wanting to do taxation return work. Now, the Corporations Act requires a lot of information to be disclosed relating to the company, what's happened to it in the past, to the directors and senior managers. So a word of warning, if you want to go down the crowdsourced funding journey, if you've ever had any problems with the Australian Security Investment Commission in the past and they've taken any action, or any court has taken any action against you, that needs to be disclosed in this offer document. And that could be a reason why you say, I don't want to go through that embarrassment, so I'm not interested, or I'm going to resign as a director now. But I believe that everyone that's contemplating utilising crowdsourced funding, equity raising, should have an understanding that information needs to be disclosed. The public must be informed. This is just like a public company raising capital. There's an investment warning in the legislation, and the government is paranoid about the investment warning being shown on all documentation. Or if any meetings are being held as part of informing people about what happens in your company, that the investment warning must be read to everyone so that everyone has a clear idea of what the investment warning is saying. The company must have current financial accounts that are prepared no later than 30 days prior to the date that the offer document is listed on the intermediary's website. So it's a fine window there that companies need to be aware of in planning the process. So that's the financial accounts, so they can be summarised in the offer document. The offer document will require the company to have already done some real analysis as to where it is at present, but more importantly, where is it going to go in the future? What is this company going to achieve? Why should a retail investor risk their hard-earned money in your company? So the sort of documentation that's going to be very important is matters like the market report. Who wants to buy this company's products? Your company's products. The marketing plan, when it's all put together in a marketing plan, what's envisaged to happen? The business plan. A business plan's a very important document. And some of the information contained in these reports and plans is going to be incorporated within the offer document. The corporate chart. How does the various sections of the business relate to one another? Details of the management team. Who is the CEO with a little bit of background? Who's the chief financial officer? Who's the operations manager? Etc. The budget and cash flow forecasts, which are linked to the business plan. What's the company expect to achieve over the next 3 years? And obviously that would show the injection of capital that you hope to raise. And all this documentation will then assist in the calculation of the share price and the number of shares to be allocated for the minimum subscription. So a company can have a minimum subscription and a maximum subscription, or it can just have a subscription, which is the minimum. It's a good idea to have minimum and then maximum, but you need to then have worked out for both scenarios how many shares are going to be allocated. And in making those calculations, you need to then be aware of what that share issue is going to do to the overall balance of power within this company. So you need to be talking to your accountants about this. So directors need to determine the minimum amount of subscription that you're going to specify, the maximum amount. But you then need to be able to articulate, if you raise the minimum, which might be, say, $1 million, what are you going to use that money for? What's it going to be spent on? And if you've identified a maximum subscription, what are you going to do with any money you get over the minimum subscription? Because investors want to know that you're going to spend this money wisely, not waste it. And all this needs to be disclosed in the offer document. The intermediary, wearing their gatekeeper role, has to approve the offer document, but also wearing their promotion role, they've also going to want to make sure that the offer document tells a good story, creates some interest. For the investors. So it's a good idea to have the intermediary involved in the design of the offer document. The company only needs to appoint an auditor once the company has raised a gross amount of $3 million in equity. That money hasn't got to be all raised in the 1 year. So if over a 2 or 3 year period, the company has now raised $3 million, the company needs to appoint an auditor. And the auditor will audit the books. The directors can appoint an auditor at an earlier stage when the company raises any money, or when the company's already raised, say, $1 million, so that there's an accountability reporting going to the shareholders. I personally believe that the auditors should be appointed when the company raises any amount of money, but unfortunately the lawmakers didn't see it that way. Closing of the offer. The offer closes when 90 days has elapsed, or the shorter period that the company's nominated, 45, 60 days, whatever. But when that occurs, the offer has finished. And the offer will also close when the maximum subscription that's been identified in the offer document has been subscribed. There is no oversubscriptions allowed over the maximum subscription. So if the company specified that the minimum subscription is $1 million and the maximum is $3.5 million, once the intermediary has seen that he has or she has subscriptions of $3.5 million, they then close the subscription. The intermediary then sends an email to the directors confirming that the minimum subscription has not been raised. An unfortunate event. It has occurred in the past and will occur in the future, undoubtedly. What the law then says is the intermediary has to refund all of that money to the people who have invested and then destroy their share application forms. You, as the company director or senior manager, will never know who those people were. That's very unfortunate. So it really highlights the necessity for the company directors to be very proactively supporting the share issue by being available for the communication facility that the intermediary has to operate, by talking the talk to anyone who makes an inquiry. If more than the minimum subscription has been raised, the directors will then be told that the intermediary is going to transfer that amount less their negotiated fee to the company's nominated bank accounts. So the target was $1 million. The actual raise was $1.5 million. The maximum listed was 3.5. So we're over the minimum but under the maximum. 1.5 million's been raised, and the fee was 6%. So it would show that $90,000 has been deducted as the intermediary's fee, and a net amount of $1,410,000 has been transferred into the company's bank account. And here is the list of the 410 new shareholders that the company has, which the intermediary would send to the company. So after that all happens, the company staff now have to prepare a share register. because the shares that have been allocated for crowdsourced funding, equity raising shareholders have to be recorded in a separate share register. And a return of allotment of the crowdsourced funding shares has to be prepared and submitted to ASIC within 30 days of the intermediary closing the offer. So ASIC's got the final report. They know what's happened. You've got 410 additional shareholders. Here they are. They all hold crowdsourced funding shares. Because these shares cannot be confused with the initial shares in the company. You might have already had 10 shareholders that 2 came about because they formed the company, and the other 8 were attracted by under a Section 708 capital offer. That section allows companies to raise up to $2 million from a maximum of 20 investors. But the maximum number of investors that a company can have in that sort of category is 50. So that type of capital raising can soon run out. So the company will have a share register for the original shareholders. Currently we've got 10. And then it's got a share register for the crowdsourced funding shareholders, 410 shareholders. The company then needs to prepare the share certificates for these new 410 shareholders and send them a letter, welcome them aboard, advise them what the company's communication policy is going to be. My suggestion, a quarterly report. You need to keep these people involved because sometime in the next 12 months or next year, you might decide that we have an opportunity to expand the business, but we need to raise a further 2.5 million. You want to be able to go back to your current shareholders. So keep them informed so that they have fairly quick buy-in to whatever you're wanting to do. Hopefully we've given you an overview of what crowdsourced funding equity raising is all about from a company director's or a senior manager's point of view. If you want some more information, please go to our website, www.esssmallbusiness.com.au. Crowdsourced funding, learn more. We're going to send you a copy of these PowerPoint slides, so you don't have to rush and start writing that down. Unless you want to, of course. But you can visit our website. We'll give you some information. You can access some free material which we're making available in a package. We've got 3 articles which give you an overview of what crowdsourced funding equity raising is all about. And we're also going to include in that package the crowdsourced funding shareholder matrix that I showed you earlier, because we really want business people to be able to sit down and have a good think about this. This will save you having to deal with banks to try to raise capital. And I think that's going to be rather difficult in the next few years in the aftermath of the Banking Royal Commission. Now, I'll be the first to admit this is not for everyone, but this information might give you an opportunity to start really thinking about it as a director, shareholder, or senior manager of a company. You can purchase some specific articles which we have written on crowdsourced funding. We're offering a 40% discount on these articles at present, and this is applicable under the 31st of March. So if you wish to obtain those articles, please go onto the website. So we're summarizing here what these articles are about. Understanding the crowdsourced funding offer document process. I've just given you an overview. If you're serious about going into this area, you need to have more information. An overview of the crowdsourced funding offer document. That's the de facto prospectus. What's involved in preparing the crowdsourced funding offer document? You're going to need your accountant or an accounting practitioner to assist you in that regard, or a business consultant. And if you can't find someone to help you on that, please contact us. Send me an email. And either we can help you ourselves or we will find one of our subscribers or affiliates who are located all over Australia to be able to have an initial discussion with you. And if you're interested in proceeding with them, they can become your advisors for this process. It's very important that you understand the intermediaries' role, responsibilities, and powers, and they have a lot of power. So we have some articles introducing the crowdsourced funding intermediary. We have a section which is looking at investor protection and their opportunities. And then what happens in the post-crowdsourced funding capital raising period. Incidentally, some people have got the view that the intermediary remains part of your team on an indefinite basis. That's not correct. Once the 90 days is over and the money's been paid to your account and the list of new investors, shareholders has been sent to you, that is the conclusion of your relationship with that intermediary. The intermediary's still got to do some reporting to ASIC, but they are finished with your company. Now, if in 12 months' time or even an earlier date you decide to try to raise some more capital, sure, you can go back and talk to the same intermediary. They'd love you to come back and talk to them, but you don't have to. You may not have really enjoyed that first experience. You might want to test out someone else, and that's your prerogative. We also have an overall combined package where we put the whole system into one package that's available for you on crowdsourced funding. Would this make you happy? If you were committed to raising capital by crowdsourced funding, in 12 months' time, you would be happy with you've raised your stated amount of capital, at least. Raise your targeted amount after all expenses relating to the capital raising. Do you want to subscribe? Please go to esssmallbusiness.com.au subscription to subscribe to any of those articles. And to obtain the 40% discount that I referred to earlier, please enter the code ESSSBC40. And we're sending you the PowerPoint slides so you can get that down. If you want to know more, please go to our website, ESS Small Business. Or if you want to, you can contact us. Peter Towers, there's the telephone numbers. 1-800-232-088 or send me an email, peter@essbiztools.com.au. And I've been forgetting to check on questions. So I'm just going to check now to see whether we've got any questions. I've got no questions. I hope that means that you've understood everything that we were talking to you about. So there's our other websites. Need professional advice? The accounting firms which are using ESS BizTools who have given us permission, you can find out their details by going to esssmallbusiness.com.au and clicking on Accountants Directory. And as long as you then insert your postcode, and that's all you need to insert, you'll find the names of accountants who are utilising our product packages that you can go and have a conversation with. They won't know who you are. You need to contact them because all that you're inserting is your postcode or other postcodes near where you operate your business from. So hopefully that helps you. That's really if your accounting firm are unable to assist you. We are developing a new professional advice system. So this is from ESS Small Business. You can visit our site, ESS Small Business, and click on to Professional Advisory Services, and we will then contact you relative to a proposal about how we can assist you on this journey. And we have broken that journey into a number of components. You don't try to do a 100-mile jog in 1 or 2 days. It needs to be phased in achievable segments. And it's the same with crowdsourced funding, but it is a journey. I can remember many years ago, a very experienced Korean businessman now living in Japan made a comment to me one day when the company that I was the chief financial officer of, a listed public company, had some real problems on a particular situation. And he said to me, "Mr. Peter, there is no gain without pain." I've never forgotten that elderly businessman who was the chairman of his company said to me. So there are significant gains for companies which are able to avail themselves of the opportunity to raise crowdsourced funding. There's no doubt about it. You don't need security. You don't need personal guarantees. You don't need monthly, you're not going to be up for monthly repayments to a bank or any other sort of company. That's the gain. But there will be some pain because directors and senior managers need to allocate sufficient time, and time costs money relative to this whole process. You will need to engage an accounting firm or other professional advisor to guide you through this process. And you need to end up with an offer document that is acceptable to the crowd. The crowd are the investors. And that's what crowdsourced funding's all about. Our team looks forward to being able to assist you on this journey. Please visit ESS Small Business and have a look at the articles which we have prepared for you to subscribe to so you can use them, so you can improve your knowledge on this very important change. The biggest change in financing for small, medium business in the last 35 years. Don't hesitate to contact us. Thank you for coming to our webinar today. Have a great day. Goodbye.